The liquidity battle between the government and the Reserve Bank has been raging for some time now. The government is claiming that liquidity constraints are crimping growth. The central bank yesterday released data to claim that credit growth is actually quite good. It released a non-food credit number of 15.6%, which is, I think, some kind of a 5-year high in terms of bank loan growth. So both to study growth and the liquidity issue, we have two economists joining us. First up, Abhishek Upadhyay, the senior economist at ICICI Securities primary dealer, joins in a minute. We also have Soumyakanti Ghosh, the Group Chief Economic Advisor at SBI. Before I come to the growth issue, Abhishek, I wanted to get your view on this 40,000 crore announcement by the Reserve Bank of open market purchases. We didn't see the bond yields react so much when crude fell by 7%. Can we see some reaction today?
Well, Lata, so liquidity situation continues to be tight. Core liquidity deficit currently would be in the vicinity of 90,000 crores. So OMOs were expected. That said, there was an element of surprise in RBI's announcement yesterday. While the OMO calendar for the month of November had expired, they still chose to go ahead and announce another OMO for this month, which is 10,000 crores scheduled for this week. In addition to that, we have the OMOs for December. So this would soothe market nerves. This week OMO was certainly not widely expected and therefore should be treated positively. Also, RBI's proactiveness in announcing the OMO schedule for December will be taken positively as well. So yes, yields should head possibly lower, perhaps below 770 today on the 10-year. But what we have seen is that OMOs typically have affected bonds specifically which have been purchased by RBI. So the curve has therefore steepened from short to intermediate tenors. So maybe that theme would still persist.
Okay, well, Soumyakanti Ghosh is also with us. Soumyakanti, morning. I'm going to come to liquidity in a bit. But before that, the other big talking point in the market is the inflation slowdown and the possibility of a rate cut by the RBI, the possibility of it in the December meeting. You think, that could take place? I mean, what's your own view?
No, I think the RBI will hold the rates because I think these talks of a rate hike or a rate cut within a span of a couple of months creates a lot of uncertainty in the market, and the central bank will stick to its path because the oil prices movement still looks uncertain even though it has dropped below 60.
Okay. Soumya, now let's therefore get back to yields. If there is an expectation that the Reserve Bank will at least sound more dovish, having gone to calibrated tightening, they obviously cannot. There's no question of a cut maybe, but maybe a very good dovish guidance. Do you think we are in for yields going down much more? There were some in the market who were talking about 7.5 and 7.4 event, very soon. Do you expect yields to go down so much if the RBI sounded dovish?
No, I think the yields are expected to go down, and as Abhishek was pointing out, I'll not be surprised if it moves below 770 today, because the movements in the yields in the last couple of days has been dictated by a lot of selling in the market. So basically, that's why the yields have moved up. But I believe that the correct after the 6th December, once the clear picture emerges on the OPEC, what the OPEC does, and I think and even the fact that the OMO now 40,000 crore has been announced in December, and possibly there will be more in the next 1 or 2 months. I think the yield should substantially move down from the current levels.
What is substantial? What is substantial?
Substantial means there is a possibility that the yields could actually touch 7.60 and it could even go lower. Whether it goes in the current month or in the next quarter, that's a matter of debate. But I think the possibility is more that it hits a target of 7.50 before rebounding.
Somebody told me 7.25, Abhishek. Not now, by March or something, because of the growth slowdown worries. How aggressive would you think the yield move can be?
I doubt we go down to those levels simply because we still retain the expectation that we are in a rate hike cycle. Yes, food inflation has surprised lower, food prices have come down, which alleviate the macro stability risks and give RBI some room perhaps to lower their inflation assumptions as well. But what we have to be wary about is the core inflation picture. You have to recall that inflation has been surprising lower all through this year. but RBI chose to hike in June and in August, and that was primarily premised on core inflation trajectory. The core inflation number which came out last month, and I'm talking about core inflation, which excludes housing and auto fuel parts, even that still continues to be above 5%. So as long as underlying inflation is still above 5%, as long as while food inflation is surprised lower, I guess the risks are clearly tilted towards it trending higher. Perhaps not immediately, but over the next few months. And with global tightening expected by key central banks, I think we are still amidst a rate hike cycle. It might be possible that we don't get any this year, but we still expect repo rate at 7% by the end of September next year. In that context, and given the fiscal worries that are quite prominent, we don't think there is a lot of downside to yields.
Okay. Well, the rate hike cycle continues. All right. Soumya, the other big positive takeaway is the credit growth, right? I mean, SBI was telling us that credit growth is now at a 5-year high, and it's seen across the board. But do you think that's sustainable? And what are your own projections as far as credit growth is concerned?
See, I think credit growth, there is a lot of interesting trends. If you look into the incremental credit growth from April this year till 9th November, which is the data is there, the amount is 4,86,000 crore, which is 5.5 times the incremental growth in the corresponding period last year. And out of this 4,86,000 crore, 3 lakh crores came in the first half, 2 lakh crores came in September only. So this means that if I net out the 3 lakh crores, the credit growth has continued to be strong in October. Now the question is whether this is sustainable or not. As of now, I think it remains a matter of debate because there was a lot of front-loading of the credit growth of the banks to the NBFCs in the month of September and October. And the real possibility of the NBFCs credit cutting will be seen once the data for the month of November is released. So I believe that there could be some amount of moderation in the credit growth because even though the credit growth has been very strong and across sectors, at 15% it's at a 5-year high, but the impact of possibly of this, any possible impact of the NBFC factor, if it is felt, could actually be noted in the numbers which in the month of November and December.
Okay. Mike, you've put another color into the credit growth picture altogether. Yesterday's RBI data said 15.6% compared to about, I think, less than 7% year ago. But you are saying that the credit growth is 5.5 times what it was year ago.
The incremental credit growth.
I get your point. Yeah. 4.5. I got your number, about 4.5 lakh crore. I mean, that's
4.9 lakh crore.
Nearly 5 lakh crore. That's huge. Yes. Abhishek, what's your sense? Do you think we are in for continued strong credit growth? Do the deposit growth also support that kind of credit growth?
Well, the credit growth is basically a lagging indicator of economic cycle. So we have seen growth pick up over the last year. What you are seeing now is some credit pickup at banks. My sense is the credit growth will ultimately stabilize at around the nominal GDP growth levels. Right now, it is, as Soumya pointed out, buffered by exceptionally low base from last year, which was obviously in the wake of demonetization. So maybe there's some more pickup immediately, but ultimately by the end of this fiscal, we should stabilize at around 12-13% growth for bank credit.
Okay. Well, Abhishek, Soumya Kanti, thanks so much for joining us. So that's about all things macro related to credit growth and the RBI policy on the 5th of December.